quick lay of the land. The government is shut down, the stock market is up, but the job market is weak. And also the Fed has cut rates and has a 99% chance of cutting rates again in October. What is exactly going on here, and how can this shutdown impact the stock market? And what is the thing we should absolutely be concerned about? Because there is one that deeply concerns me, and I do not see enough people talking about it. When I say I don't see enough people talking about it, I actually mean that. I be on the interwebs, and it may be a line in an article, but I think it's extremely serious. So I'm going to start there. The last government shutdown that we had was in 2018 under the same administration, and did last 35 days, the longest government shutdown in U.S. history. Now, what I'm not going to do is go into whose fault it is and all the politics behind it. For our purposes today, it doesn't matter the politics behind it. It matters that it's happening, and more importantly, it matters that it is happening now, because in a government shutdown, we do not have the data. The same data that I have been very loud about when it comes to unemployment, inflation, and all the important stuff that helps the Fed to know when to cut rates and how much to cut rates by. The Bureau of Labor Statistics, as well as a few other government offices, are closed during this time, including a time where the job market ain't all that great. For example, the 3-month average for 2025 for job creation compared to 2024 is just 29,000 jobs added. 29,000 jobs added. Now compare that to 2024, the average was 168,000. That's where we are for job creation. Things are absolutely slowing down. That ain't good. But here's the thing. This week, we were supposed to get a brand new jobs report. We ain't getting that now. And we don't know when the shutdown is going to end. So say if it goes 2 weeks, 3 weeks, 35 days or longer, how are we going to gauge where we are as an economy? Just vibes based on how we feel? Now, some are saying, well, yes, we do have some private data information. ADP provides some stuff. There's some consulting firms that provide some stuff. And yes, that gives us something, but most professional economists do agree that it's somewhat helpful, but it kind of provides you with a keyhole view, meaning you're just kind of looking through something quite narrow, versus a broader view, which gives us everything. So for example, from my understanding from the research that I looked at, the government clearly surveys a broad swath of things, whereas the private data and information only surveys, for example, the people who use your software. That ain't helpful, right? So let's say, for example, just to give you an analogy, an imperfect analogy at that, I'm only surveying people who use Android phones because I'm Google, and those are the people that that I have access to. There's a large segment of iPhone users that you might miss out on. So something like that from private data doesn't really help you all the time. And no, the government's data was never perfect to begin with, but in a time where the economy could be weak, you might need that data to decide whether or not you should increase rates or decrease rates or keep them stable. And I don't really think increasing rates would make sense, but that's not really the thing you want to do. Also, where are we on inflation? I don't know. We don't have the data, yet the Fed is still going to make a move. Not great. Not necessarily great. So that is the biggest concern here. What about the stock market? Now, at the time I'm doing this video, the stock market is up, and perhaps it will still be. Now, I have some data here from JP Morgan. Usually a shutdown doesn't truly impact the stock market. This time could be different. We'll see. The reason why that's usually not the case, that a stock market, that a shutdown rather impacts the stock market, is because most of the primary functions are still done, in that, you know, you still have TSA working, you still have most people for essential functions working, and once people come back, they'll get their back pay. I don't like the fact that that's a thing, because you don't pay me, I ain't coming to work. I'm sorry. I quit. Because what's the difference? What's the difference? Okay, it's just me. I'm sorry, that's just me. But according to Edward Jones, this is a line from them, but I think we can all agree to this. But according to them, the stock market performance is based on three things. It's based on stock market outlook, what do we think is going to happen, earnings, how companies are actually doing and how much money they're making, and then interest rates. Well, okay, those three things: outlook, earnings, interest rate. Outlook, earnings, interest rate. Say it one more time: outlook, earnings, interest rate. That is what drives the stock market. Well, outlook, how do we think things are going to go for the economy? We don't have the data. I don't know. How do I know what's going to happen with the economy if I don't know if jobs are growing or shrinking? Now, how do I know whether we are going to continue to cut interest rates if I don't know where inflation is? We expect interest rates to continue to go down in October, but what about the risk of stagflation, which I brought up? How does the Fed know what they should do without the right inflation data or without the right spending data? We don't know because we do not have the data. Those are two parts of that. Now, the earnings part of this is a little, problematic because companies report their information, which is good, right? They are required to do so. But a lot of that is driven just by AI, which we have talked about before. The vast majority of the top 10 companies, y'all have heard the stat before, but even of the S&P 500, I think it was 40% or so, is driven by just the top 10 companies or so. And a lot of that is just, Meta and Nvidia and others, AI growth. Microsoft. You pump a lot of AI, that's what's driving the stock market, that's what's driving the earnings. The rest of the S&P 500, whatever, throw it away, right? That's kind of what is happening. So earnings looks good. Spending, we've talked about before, the majority or half of the spending is happening with the top 10%, or we did a whole video on that. So who's doing the spending? How are these companies earning? Like, how strong are we really, or is it just moving towards that top 10% or that top 1%? I don't know. We would need data and information to truly figure these things out. So that is a little alarming and concerning. Now, as the stock market is trotting along right now, because things are relatively the status quo for them, what should you do as an investor? Because someone did ask me the other day, should we sell out? Should we panic? They didn't ask me, should we panic? Because panic is not the answer. So what should we do? Number one, you do want to add more cash. I've been saying that. I'm going to stay on that. Adding more cash allows you to be more patient and allow your investments to grow uninterrupted. So there's that. People say 3 to 6 months. I'm moving past that. Okay, 9 months may make more sense. I'm getting real comfortable saying 12 to 18 nowadays. But do what you think makes more sense. But whatever you got, you might want to add three more months onto it. Also, the patience side of things, I think, makes even more sense. As this works through, however long it may last, remain patient, remain calm in times like this, because the shutdown in and of itself historically isn't the thing that tanks the market, and the market is not in the tank either at this point in time. So I don't think that the shutdown is the thing that you should say, oh my God, this thing is crazy, let me just up and leave and sell everything and panic. But on the other side of that, outside of the cash, is historically speaking, the shutdown isn't the thing that upends the stock market, even though this shutdown, I would argue, because the data side, is perhaps the most dangerous shutdown you can have, because we are blind and we don't know what's happening. You can't necessarily prepare for what's going on. So maybe this will change if we pass the 35-day threshold and go longer. We'll see. But right now, remain patient, remain calm, stay invested for the time being, and we'll make some adjustments as we can. Perhaps we will get some more private data and try to piece together what we can, but this is not an opportunity to rearrange your entire portfolio and act a fool and do all that type of stuff, because again, the main functions of the economy and what the government spends on is relatively the same. It's not the exact same at all, right? But the essential functions are still there, even though we are not in a good spot. I don't believe any shutdown is good regardless of what the underlying decisions are. So no, don't sell. No, don't panic. Yes, add more patience. Yes, add more cash. That is where I think makes the most sense for the vast majority of investors. If you want to know how you might want to adjust your portfolio in terms of stocks, and other countries don't have shutdowns, which is why I think you might want to consider adding international stocks if you have not already. If you want to know what those international stocks and ETFs are, you want to check out this video right here.